I published a new blog post last Monday, March 9th, discussing some of my trades over the past few days. A link to my blog post can be found in my profile section here at YouTube. For stocks and stock funds trades discussed in that post, I continue to be in a risk-off mode for stocks with a net reduction of about $2,000 in my stock allocation. I do not discuss all of my trades, but if I did, the risk off would be a few $100s more than the $2,000 that I just mentioned. I'm trying to assess now the impact of what Trump calls the Iran, quote, excursion, end quote, on the U.S. economy. Since Trump uses that term to describe the war with Iran, I will do so as well. For those who thought that an excursion was like a trip to the movie theater or the beach with the family and kids, you are misinformed. The U.S. Department of Energy estimates that about 20 to 21 million barrels of crude oil and derivative products flow through the Strait of Hormuz, and about 84% of those products are destined for East Asian markets, primarily Japan, South Korea, India, and China. That data is from 2024, which is the latest I can find from the EIA. I will link a reference in the More section below. There are several reports that tankers destined for China have passed through the strait without incident. And I will reference one article in the More section below. Over the past 24 hours, Iran has successfully attacked 3 cargo ships, notwithstanding Trump's claim that the excursion was almost complete and Iran had nothing left. The International Energy Administration has recommended that its 32 member nations, which includes the U.S., release 400 million barrels of crude, and their strategic reserves are about 1/3 of the total available to those countries. If that happens, and there's no guarantee that all countries will cooperate, there would be less than 1 month of the supply that is being blocked by at the Strait of Hormuz, with the number of days dependent on how many ships are able to pass through on their way to China. So what happens if Trump's excursion continues into the summer months? So an evaluation of the impacts on the U.S. economy depends in major part on just how long cargo shipments through the strait are effectively blocked, except for some ships destined for China. Another issue is, why would Trump risk U.S. naval vessels by sending them into the strait and the Persian Gulf to accompany cargo ships when almost all of those products are destined for non-U.S. markets? It would be a political disaster for Trump and the Republicans shortly before the midterm elections for Iran to successfully attack a U.S. warship and either severely damage it or sinking it with loss of life of several U.S. sailors. And the ship was destined for South Korea or India or Japan rather than the United States. So my thinking now is that the U.S. will not be sending ships into the Persian Gulf or the Strait of Hormuz or in order to accompany cargo ships. And there's also some question, based on what I've read so far, about how effective even multiple warships would be in shooting down missiles and drones aimed at slow-moving cargo ships in the Persian Gulf, the Strait, or the Gulf of Oman. On one day, Trump repeats the mission accomplished claim made by Bush in early 2003, as I recall. Of course, the Iraqi war continued for much longer than that, which indicates that regime change in Iran is not an objective of the Trump administration. And then the next day, and I mean literally the next day, he claims that the war will continue until there is regime change. With the objectives unclear and changing from day to day, with the regime change definitely being one of those objectives, which is on again and off again, it is not possible to predict how long there will be disruption in the crude oil and LNG shipments through the strait. If regime change is an objective, and it would be difficult for Trump to leave the Iranian regime in power and walk away, this excursion can easily last for a very long time. For me, the bottom line is that investment alternatives are just unattractive to me now. While I am continuing to buy $40,000 each week in Treasury bills at auction, that is at best a running in place option, which is acceptable to me given my financial condition. Given the current yields reduced by inflation and taxes, which takes the real yield after tax and inflation close to zero. I will need a far more significant decline in stocks given my assessment of their risk, which include high valuations in the context of an economy that looks to me like it is faltering, before making a significant increase in my stock allocation. I currently own about 200 to 250 stocks, which is a rough estimate since I do not ever count the number. But the overall allocation is floating somewhere between 8 to 10% of my total portfolio held in 4 brokerage accounts. The low allocation is due to my assessment of the risk in the context of my personal investment objectives that emphasize preservation of capital and income generation. At least the T-bills generate income with almost no interest rate risk. The primary issue from my perspective in devoting funds to those kind of investments is that they mature quickly, and if the Fed continues to cut the federal funds rate, they will continue to move down in yields, which will could possibly even take the yield in a negative territory after adjusting for inflation and taxes.